thanks so much for joining us. It's a great pleasure to have with us John Heldman, President and Portfolio Manager of Triad Investment Management based in Newport Beach, Southern California. John, welcome to the program.
Thank you. It's good to be here.
Really great to have you. I look forward to learning from you about behavioral investing in practice. So there's a lot of literature on behavioral biases, but sometimes it's difficult to implement the right behaviors in practice at different stages of the investment process. And we'll talk about that, learn from you here today. Before we do so, please tell us a bit about how you got interested in investing to begin with.
Sure. I got an undergrad degree in finance and took a lot of investment courses and found that I really enjoyed reading about the practice of investing and really wanted to get into the business of investing. So I was fortunate to find something that turns out that I really love doing.
Great. And tell us a bit about exactly how you got interested in this topic of behavioral biases and how that really affects investment processes and investment outcomes.
Well, it's just been my observation after being in the business for so many years that you see so many things that happen in the investing world that don't strike you as rational, that you really come to the conclusion after being in the markets for a while that there's something going on that causes people to not act rationally. And so, my interest came from just observing booms and busts and bubbles and wondering, why did these things occur? And it really gets back to human nature, and it's something that I think is kind of ingrained in people and not likely to go away anytime soon.
So let's tackle perhaps the first part of any investment process. Really, how do you search for ideas? How do you filter them? Give us a sense of, with your understanding, knowledge of behavioral aspects to investing, what do you do differently, or what is perhaps the challenge there, and then what do you do differently?
Well, we're big fans of Warren Buffett, and we think one of the things that Buffett has pointed out is this concept of the circle of competence. We just don't think that we can be experts on thousands of companies. So we really try to. What we're really trying to do ultimately is protect ourselves from ourselves, meaning that investors can find themselves in trouble when they really try to do too much. So our focus really is to try and exclude as many things as possible, because we just don't think we can understand a lot of things just because of our limited abilities to understand technology, or in our case, or biotechnology, or some things like that. So we're really trying to exclude as many things as we can and try and focus on those things that we can really understand. And so it's really just thinking about things in terms of being humble. Again, if you have a different view that you know a little bit more than you do, that's when you really find that you cause problems for yourself. So our whole focus is to try and identify those companies where we think we have a good understanding of those businesses, and where we don't have that understanding, we're just going to stay away from them. So we really think it's behavior and trying to be rational and humble and really understanding what are your abilities and not trying to step beyond, as Buffett would say, that circle of competence.
And some investors would certainly look to screens to sort of help them insulate themselves from some emotional behaviors and biases, to run mechanical screens, right, or some checklists to search, filter investments. Help us understand how you think about that part of the investment process.
Yeah, well, one of the things, investment is all about paying now for the future, and the future typically means growth. And so how does a business grow? Well, a business grows through employing its capital and that capital earning a certain rate of return. So it's really hard to have a business grow without needing additional capital unless that business is earning a high enough rate of return that it can self-finance its growth, essentially. So what we're trying to do is find businesses where they are earning a high enough rate of return that they're largely self-funding and are not reliant on stock and bond markets for for a large part of the funding in order to grow. So that means we're screening or looking for businesses, as many other investors are, companies that have inherently high profitability, whether it's a high return on assets, high return on sales, good profit margins. We like companies where the capital intensity is relatively low so that the company doesn't have to spend all of its cash flow on reinvestment back into the business. So those are the things we're trying to set ourselves up to win by identifying companies ahead of time that have the characteristics that will make them excellent long-term growth investments. And that's one of the ways that we think we can protect ourselves from getting invested in a company that really doesn't have the right characteristics for long-term growth.
And if you then focus on these, let's say, great businesses, what are some of the behavioral biases that come into play there with that kind of approach?
Well, the behavioral bias, one of the behavioral biases with a very good business is investors have a tendency to identify a great business and pay too much for that great business. So that's one of the primary things that we spend time on is because we look at investing as investing in businesses, and we're not investing in the stock market. So we take the approach that we're going to buy the entire business. So we want to understand what the makeup of the business is, how is this business run, and then we value that business, and we try to use a rational business person's evaluation for that. And of course, the metrics and valuation techniques can vary from industry to industry. What we use as a check there is we will actually look at transaction history when a company is acquired. We'll look at those metrics and we'll use that in developing our own valuation. And ultimately, it's important to identify a good business, but it's also important to make sure that you don't overpay for that business. So that's a huge behavioral aspect, we think, is the fact that most good, astute investors who've been trained in analyzing companies can find the well-run business with above average profitability because of certain things. Maybe a company has brands or patents or so-called network effects where it's got a network that grows in value. Lots of folks can identify those characteristics, but what is really important is once you've identified them to make sure that you rationally value that business, and then ideally, you don't want to pay fair value for that business. You want to buy that business at a discount from its valuation, and that's a big part of what we do.
So let's maybe just go to some examples and that illustrate really this challenge of staying rational. When do such great businesses then become sort of mispriced, or what are some of the situations that you get attracted to? Yep. And then what is the challenge really in those situations from a behavioral aspect?
Yeah. Well, I mean, to give you an example, we invested in a company by the name of Gildan several years ago. We started following the company about 5 years ago. Gildan is a large vertically integrated sock manufacturer. Pretty mundane business, not a sexy biotech or high technology business. They make socks. Well, they're the largest sock maker in the world. They've got incredible scale, and even though it's a relatively low-tech product, if you have scale in that business, you've got a cost advantage, and that cost advantage ultimately can help you to have above-average profitability. So we started looking at the company about 5 years ago. When we first looked at it, we thought it was fairly valued. We thought it was a good business, above-average profitability, but the valuation reflected all that. So we did, as we do, we put it aside. We monitored the company as we do for all of our companies, and we kept following the company, and there was nothing unusual, no real opportunity to invest in the company. This goes back to about 2009. In late 2011, the company came out with the earnings announcement. The earnings were going to be down in the quarter, and they were expecting that the following year's earnings, 2012, were going to be impacted because cotton prices had gone up pretty dramatically, and the company was having to deal with higher cotton prices, which is one of their primary inputs. So the stock, we'd first started following the company. The stock sold for in the mid 30s, about $35. The stock proceeded to drop over a 3 or 4 month period. Basically, it got cut in half. It dropped to the mid-teens. And we kept looking at it and thinking, this doesn't make any sense to us. This is a high-quality company. Why would the market knock the value down so much? We kept looking at it, and finally it got to our price target, and we bought it. And we knew that they were going to have some earnings issues for the next 6 to 12 months, but we could look beyond that. We're very comfortable with the business, extremely comfortable with the management, and we thought, ultimately this is going to, this investment's going to work out. And sure enough, about 12 months later, the stock was back up in the mid 30s. So, I mean, that's an example of where investors' short-term mindset caused a great business run with great management to be dramatically underpriced. And why that happens, I don't really know. All I know is that it happens occasionally, and you have to be on the lookout for those things. And part of what we do is to make sure that we've identified the companies ahead of time, and then we wait for these opportunities. They don't come along very often. In this particular case, that was a once in 5 or 6 year opportunity to buy a really great business at a 50% markdown.
And give us a sense of the thought process while you're looking to invest, because you've done the work when the price was higher and then it declined. Perhaps there were some fundamental changes that you also talked about. That issue of conviction, you've done the work and you just then pull the trigger, or what's the thought process? How do you really gain that conviction that you can be contrarian and you should be when you've got certain other types of fundamental developments happening?
Mm-hmm. Yeah, that's a good question. Well, the conviction really comes from understanding the business and the drivers of the business, and also understanding the industry and the competitive situation. In this case, this was a very large company with very high market share. We didn't think that their market share was going to be impacted. We knew their profitability was going to be impacted temporarily, but we had no concerns about the company's market share. And as a matter of fact, their market share has been very stable for many years. So our conviction really came from the fact that we understood the business. We felt very comfortable with management. We'd followed management, evaluated management carefully. We knew management wasn't going to do anything foolish. And then we looked at the valuation at that point, and we had to make an assumption that cotton prices were not going to stay high forever. But we knew that cotton's a commodity. It's not, the price is not going to stay up forever. We weren't sure exactly when cotton prices were going to come back down, but we felt very comfortable that within a reasonable 2 to 3 year time frame, cotton prices would be back down. And when we looked at that and modeled the business, we felt very comfortable that the stock price was going to double over a 3 to 5 year time frame. And that's our margin of safety comes about from buying a business only when it's selling at a significant discount to our future valuation. So in our case, we'll only buy a company if we think that the price we pay represents a doubling of that stock price over a 3 to 5 year period. So in this case, we felt that we had that comfort or that margin of safety. And even if we were wrong, if we have a big enough or high enough return hurdle, if we're not quite correct in all of our assessments, we're still going to get a positive return, and we think we're still going to get a reasonable return.
What are some other types of situations that lend themselves to these behavioral biases that you can then exploit? You named short-termism as one such area. What are some of the other categories there?
Well, in terms of how we look at things, one of the things we look at is, people avoid industries just because the industry's out of favor. And it might be short-termism, or it might just be an overly negative opinion of an industry. But, the time horizon is a big factor in investing. So short-termism, we find it just rampant everywhere. Investors are, everybody's looking for good short-term performance, or a lot of investors are. So we find that, industries are out of favor for one reason or another. And, it seems to be that investors just ignore a particular industry. So, for instance, housing. We started investing in housing after the financial crisis, when the real estate market fell apart, and we didn't invest right away. But we started looking at the housing industry, and it was very out of favor. People didn't want anything to do with it. We started looking at the companies, and it wasn't an industry bet on our part, but it was a company by company analysis, and we found, amidst lots of relatively mediocre companies, we found a few companies that were really great businesses that were sort of ignored in the rubble of the housing disaster, if you will. So sometimes people can just sort of lump everything together and say, this is really a bad industry, ignore everything there. But if you're careful and you look at each company individually, you can find some really good businesses.
And I'm curious, was the attraction for you a different type of business model to a house builder, or give us a sense of what really then attracted you in that situation?
Yeah, well, it really gets back to analyzing the businesses and what makes a good business. And we think that, above average profitability over a sustained period of time, over several business cycles is important. High market share, we think, is important. Certain economic characteristics of the business, we think, that make the business more durable, or have a moat, as Buffett would say. We think those are important aspects of the economics of a business. So, for instance, in the housing downturn, we identified several companies that we thought had those characteristics. Mohawk Industries, which is the largest flooring company in the U.S. now, is a business that is a great business. They have the largest market share. With the largest market share, they've got lower costs than a lot of their competitors. And the company's run extremely well. We know management, and it's above average profitability compared to its peers. So when the housing downturn hit, Mohawk got thrown out along with most of the other housing-related companies. But we knew that, because we'd looked at this company prior to the downturn, we knew that this was a above average business. So we didn't have any hesitation about investing in this company. We knew it was a survivor. We knew ultimately housing was going to rebound. The thing that wasn't known was when was the housing rebound going to happen, and that's where part of it is short-termism, or it's just investors. They just an industry falls out of favor and people just don't want anything to do with it. Another example is CEMEX, which is one of the second largest cement company in the world. And the cement business is unique because the weight of the product means that you don't have a lot of foreign competition, because it's just too costly to ship cement from over long distances. So you have a lot of little local monopolies where you have cement plants that are scattered all around the country, for example. So the cement business is basically an oligopoly. There's 3 or 4 main companies, and the market shares are relatively stable. So again, when the housing downturn hit, all the cement companies got hit because cement is used in construction. And CEMEX was affected, but we knew that the business was durable. It was going to survive. The company was going to rebound. We were very comfortable with the management. We knew that it was just a matter of time for the business to rebound. So we look at those things. We're attracted to either neglect or when investors despise things areas. That gets our attention, because there's typically good reason for that. But there's also, if you know the businesses, you can typically find 1 or 2 really outstanding investments within an area that's neglected or despised.
And I'm curious, with the case of CEMEX, if I remember correctly, there was a lot of leverage.
Yes.
So if you think about the biases, and let's say you do get excited about a contrarian type situation, out of favor industry, company, and then what about the biases when you start doing the work that you then kind of want to make the investment, and give us a sense of some of the compromises you're willing to make and others that you don't? As value investors, certainly leverage is one of the key issues sometimes. So kind of give us a sense of perhaps the thought process there with CEMEX,
Yeah.
how you got comfortable there.
Yeah, that's a good question. CEMEX did have a lot of leverage going into the housing downturn, and actually still does have a lot of leverage. They've deleveraged somewhat, but they still got more to go. And that's one of the things, we love to find great businesses run by great management, selling at great prices. But in practice, there are often trade-offs that have to be made. In the case of CEMEX, part of the trade-off was that the company did have a high degree of leverage. And it's a fixed cost business, so when revenues drop and you've got a fixed cost business, it really impacts your cash flow disproportionately. So we looked at that, and it wasn't ideal, the fact that they had a leveraged balance sheet. In addition, management made a large acquisition toward the end of the housing boom, which did leverage their balance sheet even further. So we did look at that, and we didn't like the fact that management didn't make an acquisition at the bottom. They made an acquisition at the top of the cycle. And we consider that in looking at the rest of the investment opportunity. And we give management a demerit for making that acquisition, we think, at the wrong part of the cycle. But management's done a good job since in terms of de-leveraging its balance sheet. And we weren't really crazy about the idea that they made this acquisition, but we think that they've done a good job since. We still like the business, and we actually still like management. They're making the best of they've made the best of the difficult situation. It's been a tough environment for them over the last 5 years, but we think they've learned their lesson too. And we think that it's unlikely that they're going to make another significant acquisition like that. But those are the things that we look at. We look at management and we try and assess what are the motivations of management, and does management display the right behavioral characteristics in terms of being rational, not falling into the trap of making an acquisition just because they have the money to make the acquisition or the acquisition is available. We want to make sure that managements are mindful that they can get caught up in their own biases, and so we do spend a lot of time looking at that. And occasionally we'll get it wrong. We'll get a management that does something that we didn't anticipate. But for the most part, our track record on evaluating management's been pretty good.
What about then to take that management assessment, give us a sense of perhaps the biases there that are present that make it difficult to properly assess management, and kind of how you actually go about doing that effectively?
Yeah, management is difficult to assess because clearly you don't, management's not like reading a balance sheet or looking at financial statements. You really have to kind of get inside the heads of management and understand what are their motivations, what is this management team trying to achieve. So one of the things we do when we first run across a company that seems interesting to us is we will get annual reports, and we'll read 10 or 15 years of annual reports to actually see what has management stated over the last 10 or 15 years. And then we'll actually evaluate, is management making claims or projections that they don't follow through on. So we're trying to really understand what's the culture of this business and the management team, because that's really important to us. It's more important in some businesses than others, but we think culture can separate a great management and even a great business from a lesser quality business. So we're looking at those things. We look at their capital allocation decisions. Again, is management buying back stock at the top of a cycle when the stock market's high, or do they buy back stock when the market's depressed? I mean, we look at that, and that the record's there for us to look at. We also look at acquisitions. If they've made acquisitions, have they done it at the top of the market? Have they done it at the bottom of the cycle when things are relatively cheaper? So we're trying to do everything we can to really understand what is the behavior, what's driving this management. We also look at ownership. Is management owners? Are they owners here, or are they just agents? And what are the biases? Is the management just looking to collect a salary, or are they really looking to as if they were owners? Management can be subject to the same behavioral biases as investors, and we see it all the time. And when we see enough of that, that's something that really gets our attention and really causes us to think twice about investing in a business. We're looking at a company right now that that's one of our questions is management, and it seems like this particular management is an empire builder, and they're interested in making the company bigger, not necessarily better. We don't have enough proof to disprove that yet, but we think it's very common for managers to want to move up the ranks of, say, the Fortune 500 list, in terms of how big their company is. And so you'd think that these are large businesses run by very capable people, that they wouldn't be subject to those kind of human emotions, but we see it all the time.
And in the case of CEMEX, I guess you found a management that did make an acquisition at the top, but there were other factors that compensated for that, and perhaps is price then the sort of leveler for many of these failings, let's say, that don't necessarily check all the categories that you'd like.
Right. Now, I think that's true. Part of it was the price was appealing enough that we could factor that into our analysis of management. The other thing that management pointed out to us and others is that oftentimes these large opportunities to buy a large business, in this case it was a competitor based overseas, those opportunities sometimes come along once in a generation, and so sometimes you have to stretch a little bit. We're not always convinced of that, but in this case, we gave management some credit for that the business, it wasn't available at the bottom of the market, it was available at the top of the market, and they were looking to increase their scale. We think that it is a scale business, so there definitely is some advantage in being a larger player. So we did give them some partial credit for that, but we really take a look at that. We really don't, we prefer to have managements that are thinking more in terms of being rational and paying attention to their own biases.
Earlier you mentioned culture as an important part of the assessment. I'm curious, it's such an elusive term. What is a culture of a company? Give us a sense of what do you look for there? What are some of the biases that come with assessing a company's culture?
Right. Well, culture, you're right, is very difficult to get your arms around. It's something that you only really sense after sort of immersing yourself in the company, but reading management's comments, listening to management, even observing management in person, there's a lot of little clues that you fit together that will paint a picture for you. So, for instance, the old one of the easiest ones is just annual reports. You read an annual report, and if it's an inch thick and it's got 100 pages of glossy paper in it with a lot of pictures of senior management, it tells us anyway that this management team is not very interested in cost savings, versus another company where the annual report there are no pictures. It's just printed on simple paper. It's very simple. We find that a lot of times there's a correlation, believe it or not, between those seemingly basic or common things. Listening to managements, when we listen to either presentations or conference calls, managements that are understated in their delivery as opposed to being boastful, that tells us something about the culture of a business, and it's something that we pay attention to. There are a lot of little things that you can't point to any one thing. Sometimes management will just say things that, our culture is, such and such, and it makes it a little bit easier. But it's been my observation, it's not an easy thing to get your arms around. But I will say that it's important, and I think if you look at particularly in competitive businesses, if you look at the companies that tend to be survivors over decades, they tend to be companies that when you look back, you say, there's something about this culture that causes this company to survive. And there are certain industries where we think that culture is more important than in other industries.
Can you elaborate on that part?
Yeah. So people businesses, we think, where, as the old saying goes, the assets go up and down the elevator every night. We think the culture is very important in people-driven businesses. So financial services, for instance, it's a people business. It's all about the people. The culture there, we think, is really important, because if you don't have good culture in a financial services business, particularly highly leveraged financial services businesses, you run the possibility of finding yourself out of the game at some particular point in time, like during a financial crisis. So the last financial crisis, a lot of the businesses where the culture was risk-taking, leverage, not paying attention to some of the risks, those are businesses that ended up going out of business or being acquired at just pennies on the dollar. So, examples were Lehman Brothers, Washington Mutual, Wachovia. There are a number of financial institutions where I think it was really understood prior to the financial crisis that, in many cases, that the cultures were cultures of risk-taking and not being quite as risk-averse. And it turned out that, as Buffett would say, you only find out who's swimming naked when the tide goes out. And I think the financial crisis proved that to be absolutely the case. Now you have other businesses where they either employed less leverage or didn't take on the risky assets, where those businesses survived. A couple that we happen to like are Wells Fargo and Goldman Sachs, where we've looked at them and say what you will about Goldman, we think that the culture is one of survival, and the company's proven it. They survived. They're still recovering, but we think part of the reason why they survived is because they have a very good, strong culture.
And we talked about some of the biases that influence the investment process. I would be curious just to ask you, with this type of analysis of business and the culture and the people, it's very involved, and this question of how much research is enough, and perhaps the biases that come along with that type of work, kind of on the other side of it, maybe some positive biases where you spend a lot of time, work. How do you ensure that you stay objective and rational there?
Right. That's a good question. The one thing you don't want to do is fall in love with a particular business, or you get too pessimistic about a business just because the short term doesn't look very optimistic. So one of the ways we try and protect ourselves, because we really, it's a joke, but it's not really a joke. We really do try to protect ourselves from our own, poor thinking. So one of the ways that we try and protect ourselves is, first of all, by identifying the right types of businesses. And then hopefully we've identified and assessed management correctly. But then the third thing is, a lot of people can find good businesses run by good managements. What we try and do is have a very disciplined process for buying and selling, when need be, the positions in our portfolio. So we set up a fairly disciplined process for a purchase, and then we also have a disciplined process for eventual sale. And it's objective and rational, so it really forces us to look at companies that are either candidates for purchase or sale. And even if our own feelings about a company may be a little bit different than our system is telling us, we still look at what our objective analysis tells us to do.
Does disciplined in that context mean mechanical in terms of what is the decision making to buy and to sell then? What does discipline mean? Right.
Well, what we do is we have once we've identified the companies that we are interested in and the managements, that they go into our universe. So our universe is roughly 250 companies that we've identified ahead of time, and they're in our universe. So we place a value on these businesses. And what we're looking at is, because we're long-term investors, we project the business value over a 3 to 5 year period. So, and we look at it from a business buyer's perspective. We just don't simply say, this company is going to earn $5 a share in 3 to 5 years, and we're going to put a a 15 PE multiple on it, therefore it's a $75 stock. We don't do that. What we do is we look at projections for sales, earnings, cash flow, balance sheet changes, how is cash allocated and deployed over that time period, and we come up with what do we think if we were to buy this business entirely in 3 to 5 years, what would we pay for this business? So that's our first step. Then we put that on a per share basis. So let's say we look at a business and we say, okay, we're going to pay X for the business, and that equates to $100 a share. We then say, in order to give ourselves a margin of safety, if we project $100 per share target in 3 to 5 years, we're not going to buy it if it's selling at $80 today. We won't buy it if it's selling at $70 today. The stock has to have the opportunity to at least double over a 3 to 5 year period before we'll buy it. So we'll buy it if it's selling, in that example, for $50 or less today. So, and we do this for all of 200 plus companies in our universe. And we basically do this quarterly as new information comes out. We update our information, update our valuations, and we simply rank our universe. And we look at those companies that provide the highest return opportunities for us as purchase candidates. And so what we find is that we do an objective analysis of a company, and it may not be a buy candidate today. Things happen over time. The company's earnings might go into a temporary earnings setback. The stock price comes down, drifts down. People might get overly pessimistic about the business. Lo and behold, we might find 6 months, 12 months down the road, this business is now selling for a price that our hurdle of a doubling over 3 to 5 years can now be met. Meanwhile, we may be looking at the business saying, well, gee, this company looks like there are some problems here. Do I really want to invest in this business? So it does. The system forces us to look at the company and reevaluate it and make sure that our original assumptions are still correct. Now, things change, and we may change our valuation of the business. But what our system does is it forces us, even though we may behaviorally be thinking, is this really a great business, or are things changing, long-term things changing such that it's not a great business? And so it forces us to take another look. But if we still have our original assumptions are intact, we may be thinking, I'm not sure about this company, but that's usually a point in time when you want to invest in that business. And we find that sometimes, we just need to pull the trigger on a business, and we find that a lot of times those are some of our best decisions. So even though I'm doing this for almost 30 years, and you think that you have all the, you've seen it all, you've been through many market cycles, we still find that we are mentally and emotionally subjected to the forces of, a stock price is down, it may be down for 6 or 9 months, and you can get caught up in that and think, well, gee, this is never going to turn around. But if you go back in and look at the facts and look at the valuation, that's what we think really helps us to overcome our own emotional biases. And it works on the flip side too. On the sell side, we may invest in a business 2 or 3 years down the road, the stock price does very well. It may have done better than the growth in the business value, such that the future appreciation at that point is much less. And the same bias, you might think, gee, this business is doing great, do I really want to sell it? But we force ourselves to look at the numbers, and when the appreciation potential isn't there, we're typically trimming the position, or in some cases, we're selling it entirely.
And I was going to get to that portfolio management aspect of it. So sometimes we do see people who perhaps are not sure, or there are various different variables to consider, and maybe some compromises that one needs to make. Even in thinking back to the example of CEMEX you gave us, had management been better, or had the business perhaps been better, maybe you would have made it a bigger position. Or give us a sense of the sizing of the positions. Some people perhaps deal with their biases in this way they adjust the position size. Mm-hmm. how do you think about that? Is that a good way to deal with your biases, and how do you deal with it?
Yeah, I think so. I mean, your biases ultimately are a function of how comfortable you are with the business, how much you understand the business, and to the extent that you understand the business, how good is that business? And then the same thing applies to management. How much do you really understand management, and how comfortable are you with management? And then valuation is also a factor in that. And one of the things we always tell people is, the businesses and the people that run the businesses don't change dramatically from month to month or even from year to year. What does change dramatically, can change dramatically, is the price. So sort of like when you go to the horse races, price or the odds can dictate whether you should bet on the favorite or you should bet on the number 2 horse. It's like that in investing. So we look at those things, and if we're not as comfortable with the business and management, but the price is extremely compelling, we're willing to make those trade-offs. Although we do have some absolute criteria. We're not going to invest in businesses that we either don't understand well enough, or we're just not comfortable with the business because of some particular aspect or aspects of the business.
Now, I'd be curious to hear from you your thoughts about quantitative value strategies. So in a sense, thinking about the various behavioral biases, quantitatively minded value investors have taken the approach, well, there's always subjectivity in assessing management or the business. Let's just do the numbers, like a Joel Greenblatt type magic formula, or various other ways to rank companies, remove the biases. And what's your view on that? Give us a sense of kind of why do you think your approach is better, or what's superior, just thinking about it intellectually.
Right. Well, I've read Greenblatt's book, and I think he does have, I think he's onto something. I think he has a good strategy. He basically looks for companies that have above average profitability, but they're selling at unusually low valuations. So, his thinking is, if I can identify good businesses, but I can buy them when they're selling for below average valuations, I'll probably make money over time. And he's got a very mechanical system. The one thing I don't know is how he filters or factors, not so much management, but just in terms of the business. You can, like CEMEX, you can find a CEMEX where it's very profitable, but it's profitable at a particular point in time, say at the top of a business cycle when its profits are highest, and you can get lulled into mechanically thinking that, gee, this must be a great business to invest in because the company's making a ton of money and the PE multiple is very low. Well, typically the PE multiple is low because investors understand that it's close to the top of the cycle and therefore aren't willing to put a high multiple on those earnings. So Greenblatt certainly understands that, and he probably has ways of dealing with that. But we think purely quantitative, I'm not going to say anybody and everybody can do it well, but it's something that you can certainly, there's plenty of computer power. You can go out and screen and analyze data and perhaps come up with a decent way to invest. But in our thinking, it's a combination of quantitative numbers, but also quantitative or qualitative aspects of businesses. So we try and let the numbers tell us where to go. But once we get there, we try and use some qualitative thought process to say, do these numbers stack up? Does it make sense? Thinking about it in a rational way, while also trying to make sure that we don't subject ourselves to some behavioral bias. So for us, it's a combination of quantitative and qualitative. And again, there may be some people that do the quantitative side very well, but it's just not something that we'd feel comfortable with, just relying strictly on the numbers.
And when it comes to biases, I'd also be interested to kind of take it to an extreme and look at places, situations, whether it's by geography, Argentina or Russia today, or by sector, looking at maybe for-profit education in the United States. When you think about people's biases and this, it's easy to kind of pick spots where you are different from everybody else. It's easy to be contrarian. So give us a sense of those types of situations where it's easy to say, well, a lot of people have a bias toward that and it's obvious, everybody hates it, but it's not necessarily a great investment opportunity. And what's the thought process there? Kind of what do you exclude?
Right.
What do you, how far do you go to exploit behavioral biases, and how do you differentiate between situations that actually are good potential sources of investment?
Yeah, that's a good question. I mean, basically, what you're getting at is the so-called value trap, where you look at something and it's cheap, and it's cheap because you think for a temporary reason, but it turns out it's cheap for a more permanent reason. And so we have to be aware of that and try and make sure that if the rest of the world thinks that this is a more or less permanent problem, we think it's a temporary problem, how can we satisfy ourselves that this is a short-term problem? So it really just gets down to trying to identify a business where we think we understand the business well enough that we can identify whether this is a short-term problem or a long-term problem. It turns out that sometimes they are long-term problems, and it's best to avoid those areas. And so we try and be rational about that and not immediately gravitate to something just because it's cheap, because there may in fact be some long-term issues that make it cheap for a reason. So I mean, you brought up for-profit education. That's a good example. We had an investment or two in that area a few years back, and as we started digging deeper into it, we realized that it was changing pretty dramatically. For one, the government was making life a lot more difficult for for-profit education companies. And then secondly, we think that technology is going to revolutionize education, and we're not really sure what the outcome is going to be for some of these companies down the road. So we basically, kind of threw in the towel and said, we're not sure how this is going to develop, and because of that, we think it's better to declare defeat and move on.
Or not defeat, but just too hard. The too hard pile, right?
Exactly. In the too hard pile. Right. It's very difficult to know. There are a myriad outcomes possible in that business, and we just don't know which one is going to occur. And frankly, it's in the a lot of it's in the political realm of what government decides to do with these companies, and that's just not an area where we think we're good handicappers.
Defeat, in a way, is a victory for the right investment process that can set aside things and not feel the need to pull the trigger on everything.
Right, and that's another behavioral bias. Once you've invested in an area, even if it's just a little bit, it's tough to say, "Gee, I made a mistake here," and so that's one of the things that we think about and want to make sure that we're not continuing to hold something just because we really don't want to, even if it's just to ourselves, declare defeat and look bad. So we really have to, try and be as rational as possible.
What do you think are perhaps one or two behavioral biases that you think are underappreciated and you sort of think are misunderstood?
Well, one of the biggest ones is just the short-termism that, or lack of patience on the part of investors. I mean, investing it's a long-term process, but a lot of investors don't want to think about things over a long period of time, and I've tried to understand why that is. I think part of it is just the old cycle of greed and fear, and a lot of people want to make a lot of money in a short period of time, and it's not really rational in all cases to expect that you're going to have a high return over a short period of time. So we think that's one of the things that continually surprises us, that people are not very patient about what should be a multi-decade process.
How have you evolved your investment process when you look back and learned about some of the biases and kind of learn to deal with them and then improve your process over time. Give us a sense of that evolution of your own investment thinking process as it specifically relates to these biases and how to deal with them.
Yeah. Well, I mean, the one thing I think is that you need, whatever your system is, you need to have a system that constantly forces you in the direction of rationality. So we set everything up to try as much as possible to force us to think rationally every day. Because again, I've been doing this for almost 30 years, and I'm better at it today at avoiding some of the market, getting caught up in the what's going on in the market on any particular day. But you're still susceptible to to things over a period of time, and so we constantly set ourselves up in our systems to allow us to hopefully deal with the day-to-day noise and stay focused on the long term, because it's easy to get caught up in the fact that a stock is down and it's been down for a while, or a stock has gone up a lot, and it's easy to to kind of follow that trend, and rather than saying, wait, what's really going on here? Is something, is there a reason for me to do something differently here, rather than just sitting with the status quo?
And what is it perhaps in practice then, kind of on a day-to-day basis, that you do at your office, or just in maybe not at your office, that helps you really, as we said, implement these behavioral aspects and avoid the biases in your day-to-day investing?
Mm-hmm. Well, we spend a lot of time continually looking at the companies that we either are invested in today or the companies that we'd like to invest in. So we've got a relatively small universe, about 250 companies. I don't know what the number of publicly traded companies is, but it's probably 15,000 publicly traded companies. So we basically follow, call it 2% of the investment universe, and we avoid 98% of the investment universe. I say avoid, but we still look at those companies. We'll screen, and we'll stay abreast of what's going on in the rest of the world. But we spend most of our time in our little 250 or so company universe. And so what we try and do is every day learn a little bit more about what's going on with each of our individual companies, and try to improve our knowledge of how these businesses operate, try and stay abreast of what's going on with these businesses, continue to refine the valuations, and be ready to act whenever opportunities arise. So it's not a complicated system. It's just a system that requires the discipline to every day analyze, evaluate, assess businesses, and then if there's something to do on a particular day, you do it. If there's nothing to do, then you just sit tight and wait for an opportunity down the road. We can go weeks or even months. Well, I wouldn't say months, but we can certainly go weeks without doing much in terms of activity. And when we do have activity, it's typically adding to a position because the stock is perhaps a little weak and we think it's unwarranted, or if a stock is exhibiting a little bit of strength, we might be trimming the position. But we're typically not overly active. What we really try to spend our time on is learning and preparing for the big opportunities.
John, is there anything that we haven't discussed here that you feel is really critical to your investment process, specifically as it relates to shutting out some of these behavioral biases and realizing there's a lot of literature and we cannot do it justice here with the time that we have, but is there anything that's on your mind?
Well, again, I think having a rational process of assessing companies, and people can have different assessments of a particular business. So it's not as if I have to be the best business analyst compared to the next person, but we do all need to be in kind of the same ballpark. But so the business assessment is one part of it, but the more critical part is behaving properly and having emotional control. And that's why we say behavior beats brains, because it really is, we like to think of it as investing is 51% emotional control and it's 49% analysis. So we truly believe that The behavioral side of things is slightly more important, and it's slightly more difficult to keep your emotions under control. The analysis part can be learned, and it's relatively straightforward. It does take some work and some, some ability and knowledge, but we just think that the behavioral side is critical. And as much as many investors like to, believe that they're rational animals and think and act rationally, we just find that that's often not the case. We see it frequently in the market where things are done, again, for short-term purposes, but it makes no sense from a long-term standpoint.
If there is one thing that our viewers should take away from watching this video and sort of that would help them avoid the biases that they experience, what would that be?
Well, I think it's try to act rationally and try to understand what it is you're investing in. So if you have the time and you want to be an investor and you want to understand how individual companies operate and how to invest in individual companies, you have to know something about the business. You have to be able to analyze the business. You have to be able to place a reasonable valuation on that business, and then you have to be able to control your own emotions. And to us, those are the three things that are critical for investment success.
And when it comes to controlling emotions, what do you do differently, perhaps on a just day-to-day basis, that really helps you control your emotions?
Well, I think having established our analytical framework ahead of time, ahead of market-moving events, helps us, really feel comfortable that regardless of whether the market drops significantly or it rises significantly, we are going to stick to what we've already essentially agreed upon ahead of time, and we're not going to get overly despondent when the market's down 20%, and we're not going to get overly euphoric when the market's up 20%. We're going to look at those as opportunities to take advantage of what the market is providing to us.
On that note, John, thank you very much for your time and sharing your insights into these perhaps elusive and misunderstood concepts in investing. Thank you.
Thanks. It's been great talking to you.